G'day folks, welcome back to another update with Pete's Investing. Today we're looking at the Aussie US currency. Now the chart is showing a potential retrace after a bit of a rise on the Aussie US currency market. Before we go any further, make sure you hit that like and subscribe button to support the channel. So as of today, 24th of April, interest rate dynamics, the Reserve Bank of Australia has initiated rate cuts in 2025 with further reductions anticipated in June and November, potentially lowering the cash rate from 4.35 to 3.6. Conversely, the US Federal Reserve's easing cycle has narrowed the interest rate differential to negative 15 basis points, which traditionally supports the Aussie dollar, but now offsets by other factors. Economic indicators. Australia's weak third quarter growth figures have revived expectations of additional RBA cuts. Meanwhile, the US dollar faces downward pressure due to weakening confidence in the US economy and expectations of Federal Reserve rate cuts. Geopolitical developments. Easing tensions in the US-China trade relationship have bolstered investor sentiment, benefiting the Australian dollar. And commodity prices in Chinese economy. The Australian dollar's performance is closely tied to commodity prices and China's economic stability. Instability in China's economy has contributed to the Aussie dollar's decline, with the currency dropping below 62 cents for the first time since 2022. So we always start with the long-term trends, and on the monthly here we can see the prices below the moving averages, still showing a bearish momentum. Likewise, the CCI, after being fluctuating pretty much a flat or consolidation stage back there during the last few years, has actually broken quite strongly to the downside, so very bearish at the moment on the monthly. On the weekly, however, in the shorter term, we've got a slight rise above the moving average of the CCI, and that's also broken above the moving average of the price chart. Now, before getting too strongly bullish, I'd like to see these moving averages start curving up like it did back here, and that way we might see a bit more of a upward trajectory. On the daily, you can see there we did have this bullish divergence back in late last year, in December last year, versus lower lows on the price, and that actually bounced, hit our minimum 23-38% target range. And that 28-38% target range, if we draw a Fibonacci back to that significant high, is that 23-38% range there. You can see there it fluctuated in there for a while, pretty much went sideways, and it finally broke to the downside. And what we've got now more recently, we've got had this bearish momentum, broke down, and well, a bit of a tip here, when you see these very narrow divergence, here we had a bullish divergence versus lower lows on the price. When you see a very narrow range, often we get a more dramatic rise, in this case, a more volatile rise. So just be aware of those versus these wider divergence. So if you see a very narrow range like this, that gives you a very more volatile impact. In this case, a bullish divergence to the upside. Now notice the CCI is still pulling back into that moving average range on the daily, hasn't quite hit that moving average range on the price, so we might see a bit of a retrace in the short term. Now if we go to the intraday chart, that's where we dive into the detail, and in predominantly we'd be going, if you're trading on the intraday, like this case of the 1 hour, you predominantly take long trades in accordance with the daily. But notice here we've got a bearish divergence on the 1 hour time frame, lower highs on the CCI versus higher highs on the price. Now the first sign of a divergence, you can see there, that was probably the first sign there, probably if not that one, that was giving you a slightly higher high than that versus that same period on the CCI. That was your first sign of a bearish divergence at that point there. And since then the price kept rising and the CCI also kept dropping, but then it finally rose again. And this point the CCI is still lower than that point there for the same period on the price, giving us a bearish divergence. Now I've drawn a target area there. This one was drawn with a Fibonacci from that high. Now there's no low point before that divergence started, so I'm going to take it back to that level there of that Fibonacci range, and that's at 23-38% range of Fibonacci. That's a minimum range it very likely will retrace to. I don't trade these divergence, I just use them as a potential area to get out. If I'm going long in this case and I see a divergence, I'll take my profits off the table. So that's a potential area. It just might touch that and bounce out of there, or it could actually fall further. We can't tell at this point. We always take it one step at a time. So that's where we are with that. Now in terms of trading, you could have taken a short trade back here on the daily when that CCI and the price broke below their respective moving averages. I've got them color coded there. You would have taken a short trade there. And if I show you the back test for the short positioning, that's where this is the back test start here for the stop loss approach and the average down approach. So again, you would have gone short at that point, and you would have taken and stopped taking short positions when that CCI broke into that moving average range. And that was indicated by this period back here on the back test. So the stop loss approach generated at this point $137, and the average down approach generated $172 on those couple of trades we had there. Now you'll notice, had you kept the trade open, the stop loss approach would have gone into the negative below our 100,000 baseline, and the average down approach would have generated more income. But again, don't be fooled by that. That was just pure, I suppose, luck, if anything. You're trading against the trend. We always trade with the trend, so don't get fooled into thinking this is always going to be profitable. If I show you the bullish trades, so again, going long when the price broke above the moving average and the CCI broke above the moving average, you would have taken your first trades at that point. And here's the back test for going long, the stop loss approach and the average down approach. And again, you probably would have taken and stopped trading once that daily hits that moving average range. So you'd close out both of those trades at the moment. And at the moment, none of those are running. So you can see there the stop loss approach generated $132 and the average down approach generated $344. The only reason that even though there's similar trades, this one generated more because it held on to the trades rather than closing it out. This one waits to close it out with a take profit of 0.003%. They both have the same take profit strategy, but this one stop loss is at 0.005 and this one averages down when it hits 0.005. So basically they both hit their take profits, and this one generated a bit more in that range. So if you're new to trading, we're now including a weekly video series called Pete's Investing Plus One as part of the Pete's Investing channel. The Plus One videos are a dumbed down version of our strategies and give you a better insight into our analysis and help you follow our daily videos. If you enjoy the content and help me keep me motivated to keep doing these videos, subscribe at least on a free trial to my Patreon page where I publish weekly bullish shares across various regions of the world's markets. Think of it as sitting down with me over a cup of coffee. Thanks, and talk to you in our next video.